I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on.
Well, we live in this new environment when it comes to real estate in Canada. You have to survive a stress test at an almost 5% interest rate at a time where the Bank of Canada governor is talking about possibly lowering rates again. Why this stress test at a time when interest rates are low right now and may even go lower?
I think the reason that has been announced for introducing that 4.64% stress test rate is the possibility that the interest rate on mortgages might go higher. And it doesn't necessarily mean that interest rates generally go higher. And the Bank of Canada could even lower interest rates in January. And in fact, there was a big change as a result of yesterday's announcement. Even though they didn't cut rates yesterday, the Bank of Canada hinted that they might. And now people are projecting there could be an increase, a cut in interest rates in January or February or March. So, but that doesn't necessarily guarantee that mortgage rates go down. In fact, mortgage rates could go up, and the main reason why mortgage rates could go up goes back to all of these changes that the government has been announcing, and there's a bunch of them. Like I was just this morning trying to gather it all together, and there's so many of them that it's a big job. And there's one that I think most of us had forgotten about, which goes back a year ago, and that is that the regulator, who's called OSFI, of the federal lenders, which is mostly the chartered banks, is going to demand that they have increased capital against all high-risk loans. So any mortgage loan over 95% loan to value, or any mortgage loan where the borrower, the home buyer, had a low credit score or any number of things like that, isn't going to be as attractive for the lenders. So what that'll mean is, if the lenders have to change how they account for that loan on their books by keeping more capital, that's going to lower their profitability. So what they're going to do is they're going to raise interest rates. So you could see a scenario where the Bank of Canada was cutting interest rates in January, and the lenders in the mortgage business would be raising interest rates on the standard mortgage because they are taking more risk. And on top of that, the even bigger thing, of course, is the other announcement that was made just a couple of weeks ago, and that is where CMHC, on the behalf of the taxpayers of Canada, is not going to take all the risk anymore on these insured loans. And that is a huge thing, because that changes the whole dynamics of how the banks and the other lenders' profitability works. In fact, the non-bank lenders, if they can't lay off all of the risk onto somebody else, in this case it's CMHC or a couple of the other private mortgage insurance companies, they may not even be able to do the loan anymore. And that's because their ability to raise money could disappear altogether. Most of these companies, they call them monolines. People wouldn't feel safe investing their money directly in those companies, but they don't mind buying mortgages from them if there's 100% CMHC insurance on it. But if they lose that, if the risk element is no longer completely taken care of by CMHC, then they might have to go out of business altogether. So it's in all of that, in summary, then means higher mortgage rates, even at the same time that the Bank of Canada might be cutting other interest rates, not the mortgage rate, but other interest rates.
So real interest rates will go up then, and this stress test is probably a good idea.
Well, I think, of course, I've been talking about this for a couple of years now, And my concern was the real estate bubble and the damage that always comes after a bubble bursts. And so the measures that they're taking now are designed to not make the bubble any bigger before it corrects. Now, I was just reading a report from one of the big banks, TD Economics, and they have some of the best information available, and it's available on their website to non-clients. And they are talking about a soft landing. The problem with that argument is that there's very few examples, if any, of soft landing. So the sooner, going back to your question, the sooner they stop the bubble from getting any bigger, the better it is from the point of view of mitigating the damage when the downturn comes. And interestingly, people may have seen the announcement by Ed Clark, who used to be the CEO of TD Bank, and in my opinion was the best CEO in the last 10 years of all the banks. And he has been warning for 5 years now, at least 5 years. I quoted him in my book. I think it was the quote I used is from 2014, but it goes back further than that. And what he said then was, and what he said just a couple of days ago, was it's a good thing if the government reins in the ability of people to borrow large amounts of money to buy houses. And of course, it works against the profitability of the lenders because, they just want more and more people to borrow more and more money. But for the long-term stability of the system, you need to have some kind of limit on it. Because unfortunately, as we all know, most people, if you tell them they're approved for a monthly amount, and it doesn't look too impossible on that monthly amount, they don't really think about the total amount. They just think of can I afford that monthly payment? And then something happens, job layoff. In Alberta, I mean, we're getting all of these people that used to be making $150,000 a year being forced to take cuts down to below $100,000. Even I heard yesterday about somebody who'd gone all the way down to $50,000 and working in the oil and gas drilling business. And so you can imagine if they said they could afford that monthly payment when they were making $150,000, I don't know what they're going to do if their income drops by 2/3. So quite a few people, not just me, but quite a few people are feeling that it's a good thing that they rein in this bubble. However, my main point of disagreement with generally what people have said is that I don't see much chance of a soft landing. It's much more likely to be something worse than that. And that's why I talked in my book about surviving the Canadian real estate crash. If it's a soft landing, you don't have to worry about surviving it. But if it's a hard landing, then you do have to worry about surviving it.
And you've seen some numbers that show that Vancouver real estate has rapidly dropped in value.
Well, it's amazing. So if you look at the latest Terranet National Bank Index, which is the one that I have put out graphs on, and people can find that if they just search my name. So far, there hasn't been any change. Now, the latest one for September came out, but the problem with that index is that it only looks at prices once they're registered at Land Titles Office, and as we all know, sometimes that can be 6 months after the fact. But there's a website called Zolo, Z-O-L-O, that just put out some more up-to-date numbers, and I'm just looking at it here. So the median price, so they've got the average price, which of course is skewed by the occasional, $5 million West Van mansion that or maybe even a $30 million Point Grey mansion that trades hands. The average price has dropped from $1.5 million in Vancouver down to $1.2 million, based on this Zolo thing, and that's year over year. So we're actually a year ago. It's actually $1.2 million a year ago. Got to $1.5 million in April, and now it's down to $1.2 million. It's slightly lower than it was a year ago, which is amazing. So that's a 25% drop from the peak, and maybe a 5% drop from a year ago. When was the last time we saw a year-over-year drop in Vancouver real estate? It's been a long time. Now, this is just one index, and every index has got a different way of calculating it. And you and I have talked in the past about the effect of one or two very large trades of a very expensive property skewing the index up or down. So the possibility is that there weren't any sort of mansions traded in the period that we're talking about, and it's all just been average homes, which in Vancouver is like $1 million, and therefore the index came down. But if it's actually down a year over year, that's a pretty significant change. And he's actually got it broken out here. Zolo, the website, has got it broken out here, and I'm just looking at it here. A 4-bedroom. I don't know how many 4-bedroom. I guess that's a pretty expensive home. $2.8 million a year ago is now $2.3 million. And so some of them are up, some of them are down, but on average, they're all about even with a year ago, and 25% roughly lower than the peak, which is amazing. Really. Now, you could have an even bigger drop if you included all the townhouses and condos, which this thing I'm looking at here doesn't do that. You might even have a bigger drop in the average, because if there's very few expensive homes sold in a period, and a whole bunch of $500,000 condos, then the price would come down even faster. And that happened by the way, that happened in the U.S. When they talk about that 40% drop they had in the U.S. A whole bunch of really inexpensive homes in Nevada, for example, really pulled that average down. I don't think that in places like San Francisco and Manhattan that the prices came down by 40% in the U.S. But on average, all across the United States, there was about a 40% drop. They were selling them at auction, and people, you had to line up on the steps of the courthouse, and you had to come with cash or certified checks. And people were getting homes for like under $100,000 for probably a year or two in the middle of the depths of the crisis. So,
well, I know people who did that in Las Vegas. Yeah.
Yeah, and I had a friend who was down there. I said, "Well, how does it work?" And he said, "Well, you have to buy it. You're not allowed to even see the property." And he was buying them under 100. He said he got several for 80,000. And he said you can go ahead. Earlier they give you the list of the ones that are going to be auctioned, so you can drive by them and look, but you can't go inside. There's no key to get inside them. So he said you drive by them, and then he said, but really, if you're only paying $80,000 for a home, then you can't go too far wrong. Was his idea. But he said one of the things was you had to have exact change, so you couldn't give them a personal check or anything. They wanted actual cash or certified checks. So he would go to these auctions with all these different denominations of money and money orders and drafts and stuff, and then if he won the bid at 80,000, he'd scramble around and try and get the exact amount of money. But and obviously that's not going to happen in Vancouver. I mean, Vancouver's not Las Vegas, but these prices, the average price a year ago, which was $2.3 million, and is today $2.3 million again after having gone to $2.9 million in the peak of the craziness about 6 months ago. That could come down a lot. That could come down to 1 million or some number like that, which would be a huge drop from the peak, and that would be another 50% drop from what we're at today. And obviously, that the problem with that is, what if somebody borrowed? All these new rules we started out talking about, a lot of them are based on the people that just have less than 20% down. So far, there's no change to the rules of people that have more than 20% down. If somebody had 20% down and they paid $2.9 million 6 months ago, and now the thing's down to $2.3 million, all of their equity is gone. Like their whole down payment, which in this case would have been almost $600,000 down payment, it's evaporated. And now the mortgage is $2.3 million and the property is $2.3 million. And the lender's going to start to get very nervous. So any further drop from here, and the lenders are going to be very, very spooked if there's a lender involved.
Now, of course, we know there's real estate speculators that would love to see a massive drop in Vancouver real estate prices. They would swoop in knowing, historically land here costs a lot.
I wonder if the thing is, my experience with speculators in the stock market, it's more in the stock market than the real estate market, my career. When the prices start to go lower, those guys, instead of initially they might swoop in, but if prices keep dropping, it tends to have an effect on them where they just lose interest and they move on, because there's always another part of in the real estate. There's always another part of the world, or another place, or another, in the stock market. There's another type of stock or another type of instrument that is more interesting. And if they're what we call momentum chasers, if they're chasing momentum, they're not going to chase it on the way down. You're right. There are bargain hunters that sort of lurk around in the background, but I don't know. There's such a big commitment on real estate. It's not like buying a stock and then a week later deciding you're not happy because it's going down and then just pushing the button and selling it. Real estate's a bigger commitment. So I suspect that at least initially, if this drop in the prices reported by Zolo is correct, it certainly looks like it is, and if that declining price gains momentum, I think what will happen is it'll chase the speculators away. And on top of that, what we talked about last time, I think, was the effect of these new rules. So the new rules just came out 2 weeks ago. There's a couple of components. One is the 15% transfer tax for foreign buyers, and then the second one applies to everybody: Canadian residents, Canadian citizens, and foreign buyers. And that is the requirement to file a form with CRA and then claim the principal residence exemption if you qualify for it. And that is going to have a big impact, because if these people are chasing momentum and they haven't been paying tax, they might just disappear altogether. They might just go on, say, oh well, that's no fun anymore. I'm not enjoying that anymore. So they just move on to someplace else. But one of the things to watch, getting back to this drop in the prices, is the number of days on the market. And I don't know how. It wasn't that long ago. People were saying that the property would go up for sale and it would sell within 24 hours. So you had to move really fast. Well, that seems to have changed. So they've got now, so far it isn't a huge change. It looks like the average days on the market is about 23 days on the market for a detached home. In the 5-bedroom category, it's up to 25 days on the market. In the 3-bedroom category, it's up to 27 days on the market. But those are fairly big increases from before. And the other thing to watch is the number of listings. And the listings, of course, partly listings are a function of if they sit on the market for very long, but listings have changed dramatically. So listings are up to, in the detached segment, there's over 1,300 listings on the market right now. And that's a 33% increase from before. So, and that's exactly what happened in Calgary and Edmonton when the downturn in those two cities first started to happen. There was a huge surge in listings, and people, I guess, trying to list their home and get into the selling process as fast as they can before the prices drop anymore.
Hilliard, maybe we'll have to start looking at our homes as just homes again. Wouldn't that be nice?
Imagine that, like thinking of a home as a place to live rather than something like a stock to trade for profit. I don't know how that's going to be such a big change. And the other thing too is not talking about it all the time either. Like, we'll have to find something. We're going to have to find something else to talk about if this trend continues, because people won't be interested in. I think it'd be a good change. People get away from the idea of housing as an investment, because there are other investments that are much more productive for an economy. Investing like Vancouver's, for instance, a pretty big high-tech center. Now, I understand that some of those companies have been driven away from Vancouver because of the high cost of living there, but there's a pretty good community of technology companies there. There used to be a pretty good community of movie production companies. I don't know if that's still the case. And there's a lot of other things in the world besides real estate and residential construction.
Well, the high rents here have forced students to live in homeless shelters. They can't afford an apartment. It's the truth.
It's crazy. We had that in. I remember having this argument 3 years ago with people in Edmonton. And when I was starting to work on this before my book came out, and I would get the pushback when I said, the prices just are too high and they're going to come down, and they say, oh no, there's people moving to Edmonton to work in the oil sands, for example, and you know that there's such a shortage of housing. People are living in homeless shelters. People with jobs are living in homeless shelters. And every once in a while, the local media would do a story on that and interview some guy, and he said, "Yeah, I got this job in Fort McMurray, and I have no place to live, so I'm homeless. So I'm living in the homeless shelter until I can find a place." And so all of that has changed now, and it's completely different. I was just today just driving by a house, and I thought it was a for sale sign. I've never seen this before. It was a realtor. It wasn't Remax, but it was one like a national firm like that. And it said for rent. It didn't say for sale. It said for rent. I've never seen that before. So I got to phone one of my realtor friends and find out how that works. And every single apartment building in Edmonton and Calgary, of the walk-up types, you know, the up to 3 or 4 stories, every single one of them has a for rent sign. And they usually say bachelor, 1 bedroom, 2 bedroom, any accommodation if you want to rent. And they give all kinds of incentives as well. They're reluctant to drop their monthly price. So instead what they do is they give you a couple of free months of rent, or they'll do all kinds of things to attract new tenants. So they're desperate for tenants. So if those students can't find places to live in Vancouver, they could come to Edmonton or Calgary, and there's universities here. They could probably get a much better deal here.
We'll have more with Hilliard Macbeth right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. Switching topics now from real estate to who's going to occupy, well, a nice house that's white in Washington. How is the U.S. election going to affect Canada?
Well, one of the most important things they've talked about, and it's been mostly from the Republican candidate Donald Trump, has talked about tearing up free trade agreements. Now, of course, the president can't tear up free trade agreements. They are ratified by the Congress. And they're a commitment that lasts longer than a president's term. So he's not able to do that. However, he has, it seems to me anyway, that like he's made some inroads into the popularity of the Democrat, Hillary Clinton, because he accused her of being in favor of these free trade agreements, and he says they're a disaster and we should renegotiate them and get a better deal. And the way Trump talks about that, it gives the impression, I think, that the polling that they're doing tells them that they've hit a nerve. People in the U.S. are listening to them. So this is one of the things that could be a problem for Canada if somebody is able to tear up the free trade agreements, and I don't think that they would be, but if whoever wins, and it's more likely that Clinton will be in, the attitude may have shifted to the point where it's going to get much tougher. Like already we've got a dispute, which seems to happen about every 5 or 10 years, on the softwood lumber, which was supposed to be part of free trade. But what happens is the states that are impacted by softwood lumber coming out of British Columbia file a complaint because they say that there's subsidies in Canada, and then they somehow manage to get the thing removed from free trade and get duty slapped on it, and they do it about every 4 or 5 years. And so we have to re-justify our softwood lumber exports to the United States, even though it was supposed to be part of NAFTA. So whoever wins the election, I think I would expect there'll be more difficulties with trade agreements between Canada and the United States.
Well, the U.S.'s biggest problem with trade is the high value of their dollar. When are they going to recognize that?
Yeah, well, it's unfair though. It's unequal because they don't rely very much on exports. They're pretty self-sufficient in terms of what's going. There's certain industries like steel and softwood lumber, and maybe cars, where there's a significant amount of exports into the United States, but of stuff that they care about, right? And but most of the stuff they don't really care. and it's only about 10%. In Canada, though, it's 40% of our total trade. So we are vulnerable, and they're not. And so that unfortunately means that we kind of have to live with whatever they want to do to us.
Does it mean that we just have to concentrate more on Asia and Europe, and maybe the U.S. won't be our biggest buddy?
I think we can't get away from the fact that the U.S. is always going to be our biggest trading partner. We'll just have to. One of the things I think we'll probably have to do, and Bank of Canada, where we started out this conversation a few minutes ago, the Bank of Canada cuts rates in January, February. Our Canadian dollar might need to go down quite a bit more. Like it went down to 70 cents roughly. It rebounded back up to 78. Now it's around 75, 76. It might have to go back down to 70 cents again, because that's where a lot of our exports get more competitive. But there's a second thing that could be a problem for Canada with the U.S., and that is defense spending. So the other thing that Donald Trump has made some points with his argument is that the other countries in the coalition for defense are not paying their own share, and that's certainly true. Like the U.S. spends so much more on defense. Now they use it as for all kinds of reasons other than defense, as a job creator and all kinds of things, and they hand out political favors with their defense budget and everything. But it's enormous. It's an enormous amount of money that they spend. It's like, I think I'm going to guess here now, it's something like 4% of their GDP.
Well, Canada, though, isn't in the business of invading other countries on a monthly basis like the U.S. is.
No, that's true. So Canada is down around 1% of GDP. And so the NATO commitment, so all the members of NATO are required, or at least they're expected, to spend 2% of their GDP on defense, and Canada's at about half of our commitment. So at a very minimum, I wouldn't be surprised to see us, no matter who wins, Canadians would be expected to increase our spending from 1% to 2%, which is a pretty big number. It's about $19 billion. To give you an idea, the much vaunted infrastructure spend program that Justin Trudeau's talked about since he got elected a year ago is about $11 billion a year, and that's a fairly big amount of money that's going into infrastructure and different things like rapid transit. It's up to each individual. I think they're sharing with the provinces and with the cities as to what kind of infrastructure people want to do with that money. So this potential increase in defense spending would be almost twice as big as that. So it would have a big impact. Now, I don't know how we would spend that much money. We don't have I don't think we have the companies in Canada. We got Bombardier, we got a few other companies like that, where we could ask them to give them contracts to spend more money on defense, or we could hire more people to work for the armed forces. But there's going to be pressure, so we're going to be under a lot of pressure in both areas. But getting back to the housing thing, one of the big benefits longer term of getting the house prices down is we, as a country, we could become more competitive, and our exports would be more competitive. So the Canadian dollar going down helps, but the costs, which basically come down to things like housing and cars and that sort of thing, so that you can pay people a reasonable wage and they can still, make a living and start a family and have a nice life. The extremely high cost of housing is holding us back. We need to get you go to Texas, the average house price is probably about half of what it is in Alberta. And our product is the same. It's oil and gas, right? So we've got a real problem in terms of the Americans now have a choice. They can buy their oil at home. They don't need to come to Alberta and buy Alberta's oil. So we need to get our costs down. And the housing cost is the biggest cost usually in the household.
Hilliard, on a brighter note, Tesla says from now on all their new models will be self-driving. You have a Tesla. What does that news mean to you?
Well, I was excited to read that, and then I read a little further in the fine print, and it said, unfortunately, and actually Elon Musk put this out by tweet on Twitter. Unfortunately, it's so expensive to retrofit an existing car with the new technology that it's not going to be done. So basically he's saying, in order to get the new self-driving features, you'd have to trade in your old car and buy a new car. So my car is only 6 months old. So, that was kind of unfortunate. But in the meantime, they do upgrade the software in the car periodically. I think in the last 6 months there's been 3 software upgrades. So they keep improving or fixing flaws. Some people would, some more skeptical people would say fixing flaws in the operating system of the car. It's almost like an iPhone or something where you get these updates and stuff. And
but you're still happy with it, aren't you?
Oh yeah, and you know what? I don't really see the self-driving thing as being that big a deal. Like if you're in the car anyway, I mean, what are you gonna? I mean, I don't at the moment. They were calling it autopilot, but now I think they're going to be forced to not call it autopilot anymore because it's really not autopilot. You still have to. You're still in charge of the vehicle, and it does a lot of stuff without the driver having to intervene. But the driver's still on the hook for emergency response and that sort of thing, and you're supposed to keep your hands on the steering wheel even though you're not steering. So that's the state of my situation. And if you're in the driver's seat and you're doing that anyway, it's not really that big a deal to maybe have to steer a little bit once in a while or put the brakes on. You almost never have to put the brakes on because the car adjusts to the other traffic and that, and so you can just let the car do that. But so I don't really see that. Like the example he used. He said, well, if you were sitting at home and the car was parked at your, 5 miles away and you just pushed it on, like I have on my phone an app that says summons, which right for my car, you could just use it to get your car out of the garage or put it back in the garage if you're standing right there. But this new thing that they announced, you'd be able to summon your car from like a mile away or 2 miles away and it would make its way through all the streets and then show up. So, but I was trying to imagine a situation where that would be useful. Now,
well, I can. What if you have to pay $120 a month for a parkade? Well, now your car can go park in the suburbs where it's free.
Yeah, or you could go so actually somebody said that. I said this morning and somebody said, well, what if you go to so we've got this new hockey rink in Edmonton and it's called Rogers, seems like other ones are called that too. But it's right in the middle of downtown, which is kind of unfortunate for parking, right? So the idea would be is you would go to the hockey game and maybe put your car 6 blocks away, like you say, and then when you get finished with the hockey game, you just push the summons button and your car shows up in front of the door along with everybody else's cars. So I don't know how that would work, but I don't think it really solves the problem though, which is too many cars on the road, right? It's still getting the car, whether there's a driver in the car or no driver in the car, it's still a car on the road that's occupying a space. So it seems like the better solution would be somehow to get those cars off the road. And I don't know what but I think it certainly is. It's an exciting new technology, and I think Tesla and Elon Musk especially is using it to keep the interest in the car among the public. And of course, the big test with Tesla is not going to be this autonomous car thing, which is a bit of a gimmick. The big thing is going to be the Model 3, which is supposed to be entering production in the middle of 2017 and available early in 2018 or even late 2017. And this is a huge thing. And it's not going to depend on autonomous driving. It depends on what's the cost for the battery, what's the cost for the car. They're still talking $35,000 US for the base model and all of that kind of stuff. And what's the range going to be on the battery? So they've announced a lot of that already. The question is, can they deliver? For $35,000, it's a pretty tall order to deliver a car like that. The current ones they produce, the only ones they produce right now, start at 3 times that cost. So that's the huge bet. That's the huge gamble that Elon Musk has made. And if he can pull it off, he's going to change the automobile industry forever. And but there's a chance he might end up failing spectacularly too. We won't know we're going to know pretty soon. And literally in about 6 to 8 months, we're going to know if he's pulled it off or not. But it's and the stock's trading at $200 US, which implies a market value of about $32 billion, which means that people are gambling that he is going to be able to pull it off, because he has done a lot of things so far that have been quite successful. But there's no guarantee he's going to be able to do it. And that $32 billion valuation could be a lot lower if he even has to delay the delivery by a year or two. I think the price of that stock would come way down. However, if he succeeds, that valuation could go up quite a bit higher as well.
Hilliard, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.